The global expansion of artificial intelligence is fundamentally a story of physical constraints, where the primary bottleneck has shifted from chip supply to power and cooling infrastructure. Hyperscalers, including Amazon, Microsoft, Alphabet, Meta, and Oracle, are projected to reach approximately $690 billion in capital expenditure by 2026, with roughly 75% dedicated to AI infrastructure. This capital flow treats the AI ecosystem like a combustion engine. While the GPU is the spark plug, the engine requires fuel in the form of power, thermal management for cooling, and a chassis of real estate to function. Within this framework, two assets dominate the compute and thermal layers. NVIDIA functions as the primary compute engine. Its competitive advantage is not merely silicon, but a decade-deep software moat via CUDA and a systems-level architecture that integrates thousands of GPUs into a single logical machine. In the first quarter of fiscal year 2027, data center revenue reached $75.2 billion, notably split between traditional hyperscale demand and a growing segment of enterprise and sovereign AI clouds. While the company generated record free cash flow of $48.6 billion with a 74.9% gross margin, it faces structural risks. These include heavy customer concentration and geopolitical exposure, specifically regarding export restrictions that previously accounted for billions in revenue. Supporting this compute layer is Vertiv Holdings, which provides the critical thermal and power infrastructure. As GPU density increases, traditional air cooling is being replaced by mandatory liquid cooling. Vertiv's value lies in solving these complex systems integration problems at the rack scale. Its $15 billion backlog serves as a transparent indicator of realized demand. However, as a cyclical industrial business, Vertiv's valuation is sensitive to any deceleration in hyperscaler spending, and its execution remains dependent on navigating complex supply chain and capacity expansions.
The middle layers of the AI power grid consist of land, interconnection, and networking fabric, where scarcity of power entitlements and low latency connectivity create high barriers to entry. Digital Realty Trust operates as a specialized REIT, where the primary value is not the building, but the secured power interconnection in restricted markets. With a development pipeline of $16.5 billion that is already 61% pre-leased, the company demonstrates high revenue visibility. Its record $707 million bookings in a single quarter highlight the demand for massive hyperscale blocks. The primary risks for Digital Realty involve high capital intensity, with debt to equity near 76%, and the potential for hyperscalers to bypass third-party landlords by building their own facilities. Equinix addresses the shift from AI training to inference, where proximity to users and data is paramount. Unlike wholesale providers, Equinix focuses on interconnection density, facilitating traffic exchange between enterprises and networks. AI-related connections through its Fabric product tripled year over year, leading to a record 51% adjusted EBITDA margin. While generating over $1 billion in quarterly AFFO, the company must continuously reinvest capital at the pace of its operating cost flow to secure capacity in power-constrained metropolitan areas. At the networking level, Arista Networks provides the fabric allowing GPUs to communicate as a unified cluster. By championing an open Ethernet-based architecture over proprietary alternatives, Arista has secured the top market share in high-speed switching. Its Q1 2026 revenue rose 35.1% to $2.7 billion, supported by a 47.8% operating margin. Despite this, Arista remains vulnerable to extreme customer concentration, with Meta and Microsoft accounting for over 40% of revenue. This makes the stock highly sensitive to even minor adjustments in the capital expenditure cycles of a few key players. The final and most fundamental layer of the AI build-out is power management and generation.
Eaton Corporation occupies the physical handoff point between the utility grid and the data center floor. Its incumbency in providing transformers, switchgear, and uninterruptible power supplies has resulted in a data center order increase of 240% on a rolling 12-month basis. The company's electrical sector backlog now represents approximately 12 years of work at current build rates. While Eaton is a structural winner, it faces integration risks following the $9.55 billion acquisition of Boyd Thermal and potential dilution from non-data center industrial markets. Upstream from the entire grid is Constellation Energy, the largest operator of carbon-free nuclear generation in the United States. For hyperscalers requiring 24/7 clean power that does not fluctuate with weather, nuclear is the only viable large-scale solution. Following its Calpine acquisition, Constellation manages over 55 gigawatts of capacity. Management guides toward $11.5 to $13 billion in free cash flow for the 2028 to 2029 window. The investment thesis here rests on the conversion of the interconnection queue into firm contracts and navigating the regulatory complexities of co-located data center loads. In summary, a disciplined portfolio architecture categorizes these assets by their risk-reward profiles. NVIDIA and Digital Realty serve as core anchor holdings due to their established moats and revenue visibility. Vertiv and Arista act as high-beta tactical satellites, offering high growth but greater sensitivity to order acceleration cycles. Equinix and Constellation provide longer duration exposure to interconnection and energy. Investors must recognize that while these companies sit at different points in the value chain, they are all ultimately linked to a single variable: the continued compounding growth of hyperscaler capital expenditure. If that growth merely plateaus, the entire infrastructure basket will likely undergo a synchronized downward re-rating.